Hi. What is the appropriate level of diversification during a financial crisis like we're experiencing right now? My name is Gary Mishuras. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So I think that a lot of people have become, or it's been fashionable to become a concentrated investor. By the way, I'm a concentrated investor. I'm a fundamental value investor, and I typically invest into 10 to 20 well-researched investments. But I think it's important to think about why we're doing things and think from first principles and not just do something because, oh, I want to be a concentrated investor because that's the best. That is not necessarily the best. It is one dimension of an investment style, and it's related to both your other parts of the other parts of your approach, but also the environment. So let's think about what's the cost of diversification? Because sometimes people say diversification is a free lunch. And it's not, it is not a free lunch at all. The cost of diversification, at least for someone who's making individual investments, is that there is a slope to the line that measures how attractive each security is that you've analyzed. So let's just think about in terms of future rates of return. Let's say the best investment you were able to find offers you a 25% annualized rate of return. The next one is 20, the next one is 15, the next one is 10, and the next one is 5, just to give you a stylized example. Well, if you were to diversify into all 5 of these investments, you're going to bring down your average rate of return. Because if you were just investing in your best investment, 25% internal rate of return investment, you would have higher returns than if you have all 5. Now, why do we diversify? Well, because we can be wrong, right? If we knew for sure how the future would look, we would just buy our best investment, but we don't. So there's that tension, but there's definitely a cost in the sense that you are adding less and less attractive from a perspective of expected return investments as you diversify your portfolio. The second cost of diversification then is the time it takes you to understand and value these investment opportunities. And it actually, honestly, doesn't even matter if you are the biggest firm in the world and you have 100 analysts scurrying around doing this work for you. Because if you're a really good investor, you're not going to delegate the actual really important parts of the investment decisions to junior analysts or even senior analysts. I don't care what their titles are. You're going to get information from them, maybe some intermediate analysis, and you're going to make your own judgments about the quality of the businesses and the values of these securities and so forth, at least to a large degree. And so there's a bottleneck in that process. There can only so many things that you can process at once, and to the same level of quality that meets your standards for what you want to do in terms of research and due diligence on a potential investment opportunity. So those are the 2 costs of diversification. It's bring down your expected return, and it's the time it takes away time from researching other investments, as well as do maintenance research in your existing portfolio and so forth. Now let's think about this in the current context of the current environment. Well, in the current environment, they're starting to crop up more and more really cheap distressed investments. And that means that more and more investments are offering really attractive potential rates of return. So, if in an environment where there are very, very few attractive opportunities, you want to be more concentrated, whatever that means for you. But in an environment where there are more and more really attractive opportunities, that aspect of the cost of diversification declines because if you think about, you had 12 investments, let's just say, and now this 13th investment that you're thinking about adding, it's very unlikely to bring down your total return very much because it's also very cheap and very distressed. So the difference between each succeeding investment in terms of its prospective future rate of return diminishes in an environment where there is just massive panic and selling across the board. So I think an environment like we're in today argues that to the degree that you can, in terms of that mental ability to process information and analyze businesses, you want to be more diversified than you would be in an environment like we had in the last few years, where I would argue, and I had argued, that there were very few attractive opportunities. So I think that rather than thinking about this in very doctrinaire terms of I'm going to be concentrating, I'm going to own 10 investments no matter what you want to do is you want to apply a set of criteria and filters to an environment and say, how do I construct a portfolio that promises good safety of principal characteristics and also attractive future returns? and how do I optimize that given my style, my process, and my ability to process information into the best portfolio I can find. So for me personally, as Silvering Value Partners, this is implying now that I'm becoming a little bit more diversified than I would otherwise be. Now, am I going to own 100 securities? No way. That's not what I do. I don't think I can do the kind of research I would like to do on 100 or even 50 investments. Maybe others can, and more power to them. But that's not what I do, and I'm not going to worry about what others do. I'm going to worry about what makes sense to me from first principles. However, if maybe I had about 10 investments, going in, I might come out of this, but maybe 20 or even a little bit more, because I feel that more and more businesses that have been on my watch list that I've researched in the past are hitting prices that are attractive. Now, we're not at the point, as I've talked about in the previous video, of complete capitulation or every security is at rock bottom prices, but I'm able to find more incremental opportunities. And because of that, I'm willing to add a few more securities to the portfolio than I would in a market where there are fewer opportunities available. I hope this video has been helpful to you. If it has, please hit like and subscribe to my YouTube channel. Thank you, guys.